Hi everyone, I've come here to do something that I hate, which is a quick sales pitch. On the 16th of January, Adam Lawrence and I are hosting our 5th property business workshop. If you've come to ones before, you'll know they are packed full of information for existing property business owners and portfolio holders. Normally, it's not the sexy stuff. It's the things that property business owners leave off or try and put to another day. But we get down to the nitty-gritty to help your property business scale. What we're going to be doing in January is focusing on productivity, looking at financial accounting and bookkeeping procedures to make sure that you understand all that data that's coming out of your business and how to act on it in terms of risks and opportunities and what are the metrics to track. As I said, it's the 16th of January. You can check out more information here. Please do come along. Tickets are selling out fast. And if you've been to one of them before, you will know that they're fantastic events, not just for the information, but also for the networking as well. They do sell out quickly. They're always sold out. So please, please, please click on that link and have a look and hopefully see you there.
Welcome to the Rodcast with Rod Turner, the show all about real estate. We discuss everything that affects asset-backed businesses, investments, and go deep into the details with some of the best in the business.
Hello everyone, and welcome to another edition of the Rodcast. Today, I'm really sorry to say it's just me you're putting up with, but I've got a death by PowerPoint presentation for you. I know it's exciting, isn't it? But there is an awful lot of information here because I wanted to get this all down for you, really to give you a residential market update. So I'm going to be going through loads of data, loads of graphs. I'd love to hear what you think about it, if this format, you enjoyed it or not. Maybe we can make it a quarterly or 6-monthly thing. Please do let me know in the comments or wherever you've seen this. Hopefully you're watching it on YouTube. If you're listening via one of the podcast apps, maybe go over to YouTube because there are quite a lot of graphs and charts to have a look at. But hope you enjoy and hopefully it gives you some information. So what we're going to run through is a bit of information on rents. We're going to talk about house prices. We're going to talk about affordability metrics. We're going to look at history and some previous corrections and why this time may be similar or different. And we're going to look at lots of different factors that do affect house prices. We've got an awful lot of data, as I've said, from the likes of ONS. We've got HomeLet, Dataloft, Zoopla, Nationwide, Halifax, and many, many more. So thanks for all those. And it's not our own data. We're just compiling it, also from the Treasury too. So we're going to start off with the ONS and looking at private rents. So average rent in the UK was £1,307 in October, according to the ONS. We can see that they've increased by 28% in 5 years, up to October 2024. What we like to look at is average year on year, not just picking up from last year because years are different, but the 5-year average is about 5% year on year growth. Approximately about 1% for the first 2 years, so really, really low growth, and then it jumped up. So we saw in the last 2 years there's been about 8% per year growth in rents, which brings it out to actually the long-term average, which is about 5% a year rental growth. So again, it's funny, isn't it? Because we're looking at 1% year on year for the first 2 years, which doesn't sound a lot, and then 8% for the last couple of years, which really bumps it up and does sound quite a lot. But ONS stuff is not great in my view. It's as good as we can get to a point. The problem is it's about 450 different data points that they look at, but it's quite slow. And I'll go into that in a little bit. Here we can see what we've got in terms of average rent increases across different regions. Now just look at London there. That's about 11 and a bit % in London over the last year it's gone up by. Take a good look because we're going to discuss that when we move on to some other data sets and why actually ONS can be a little bit slow off the mark here. So if we go over to HomeLet, which gets its data from Dataloft, now I really, really like this data set, and the reason I like it is it's because it's taken from 1 million, I'd say that again, 1 million different deposit sources. Okay, so what they're looking at here is when they're looking at your, credit agencies, when they're looking for your deposits, so they're looking at up-to-date bank accounts, they're looking at kind of what your income is at the time, they're looking at new rents going on. And new rents is really, really important. ONS is good because it takes existing and new, but new rents is really, really useful for us. And actually what this is showing is UK as a general has not gone up by that kind of 8-9%, it's 3.4%. But actually, if you go back a year, it was showing much higher margins. So what we're seeing is actually the growth, although it's still growing, which is nice for us to see, the growth, or rate of growth has really decreased. And actually, there's a really good pattern which shows that the HomeLet data or Dataloft data of new rents, actually you can see how that affects the ONS data about 12 months later. So there's about 8 to 12 month lag on that one. And we'll see that a bit more as we look at the regions. So again, in London, you can see actually the growth of new rents has come to almost a standstill. It's about plus 9%, okay, in there. So we can see rental growth has dramatically reduced back to the 5-year average after 2 very, very strong years, like we said. Biggest reductions are in Northern Ireland and London. Okay, so we'll go into some of the London boroughs in a second. You'll see there's a massive, massive difference between where you are, as always there is in London, because you're dealing with very, very different markets. West Midlands is the only region where the rate of growth is bigger than it was last year. Okay, so that's really interesting. We're seeing across the board, apart from the West Mids, that the growth has reduced compared to last year. There's still growth, okay, so it's still nominal growth, but it's the rate of which it's growing is much less than it was. And I think that's important because when you look at the ONS data, it gives you a little false sense of security in my mind. So again, looking at those different regions, again, it's really interesting to see how those affected, especially from last year. So again, London, where are you in this light blue? Look where it was last year at 10.2%. Okay, so really high like the ONS is showing now, but look at it now, 0.9, so pretty much no growth there in London in the last 12 months. It's had all its growth there before, whereas now you've got West Mids, like we said, the only one that's outlying. So UK rents, we said that's an average of 1,327. It's gone up from £953 5 years ago, so in October 2019, that's a 44% increase, much, much bigger than that ONS figure. Or annualised, it's 6.8% year on year, rather than that 5% year on year. Now, I do tend to like this data set. Like I said, it's much more up to date in my view. Some other people disagree with me, but there are really, really robust patterns that actually show this, like we've seen 12 months ago from that new rents data, and how that really mimics what then the ONS tends to show a bit later on in their lag time. So we've seen that if you've been renting out properties and if you've been doing new rents or even raising your rents with market rate, gosh, there's been a massive, massive increase in 5 years. If we look into London, like we said, there's about 0.9%, so barely any growth in the last year, but there's massive differences between locations. So you can see sort of Harrow and Hillingdon, 16.1% growth. Yeah, and then you've got places like Wandsworth that are minus 7%, so they've actually gone down. Okay, and we're looking at the time we are, the seasonality, we're looking at this end of October. September, October, you usually get a bit of a spike in rent. So it's interesting to see such a massive, massive difference and disparity in the locations where you are in London. Obviously, it's going to affect the different types of property and different values. And really what you can tend to see is typically those boroughs that are much higher in value, so your Westminsters, your City of Londons, your Camdens, your Wandsworths, some of Lambeth, they're the ones with the higher value properties have actually gone down, and you've not just had the growth decreasing, you've had rents nominally decreasing. Okay, so something interesting there to think about. Affordability of rents then, if we look at this, we've got the UK in general as that black line, and really what we're looking at is the percentage of someone's gross income, and it's a household's income. Now remember how many people we have in a household and how many earners there are. It's not just one, we don't live in 1950 anymore, it's a few more, and I think it's about 1.6 is the average. It's always a bit difficult with averages, like we always tend to say. It's like the 6-foot man who died crossing a river that was only 5 foot deep on average. Okay, so always take it with a pinch of salt. But what we are seeing is rents are becoming less affordable. Yeah, so the percentage of what people are paying or what households are paying on their rent is going up. So 32.8% of households' income was spent on rents in October, down from 32.9% a year ago. So barely any change at all, okay? But massive, massive differences between different regions. Okay, so we'll see that the greatest change in the last year has been in the northeast, where rents have taken up an additional 11% of a renter's income. That is massive. Versus, compare it with Scotland, where rents take up 0.8% less of a renter's income. Okay, so huge differences there between how much of your household's gross income is being spent on rent. So massive difference. And actually we saw about a year ago, if anyone had come to one of these sort of presentations that I used to do live, where we went through a lot of this data, we said the northeast looks pretty ripe for some affordability movement there, and what that tends to mean is actually it's affordable now, it's shooting up and catching up with everywhere else, and things like minimum wage increasing and that kind of thing will affect those. So there you have it in a map form. Okay, you can see there that that's the northeast has gone from 22% of a household's income spent on rent to 33%. That is massive, and although it's 11% nominally, the difference between 22 and 33, I mean, the good people at maths will probably tell me it's about 30 odd percent, I reckon. So that's a massive difference. Okay, looking at London, yeah, about 0.2%. Southeast, okay, has actually become more affordable than it was a year ago. Okay, so yes, some of those are interesting to see. Again, Scotland more affordable as well. So, average rent of rooms. Why do we look at room rents? Well, a bit like looking at new rents versus kind of total rents, it gives us a lot more of an update in terms of where the market might move as a whole, because room rents represent the most transient of tenants, okay, because they tend to move a lot more often, and so that's why we like to look at this spare room index. Okay, and what we can see is average room rent in the UK is £745, or if we exclude London, £660. So that's only up from it's only up, by about £5 in the last year, okay, as a whole. So from the start of this year, it's really barely moved, which is really interesting. So actually what, again, that's kind of telling me here is that this is a market indicator of rents for the total market. That's why I like to look at room rents. And what that's telling me is to expect very little growth in that market, maybe for the next 12 months. Okay, I'm not saying in total, but I'm saying a little bit of less movement. Now that's going to be massively different where you are and what your properties are, but it's showing actually that if we look back at the ONS data in a year's time, I wouldn't be surprised to see if we see very little growth there. Okay, so London increases have fallen for 4 consecutive quarters. Okay, that's interesting. So it's actually, they've fallen. Okay, there's still growth, but it's below inflation numbers. So in real terms, rents are cheaper. Edinburgh is the only town or city that's not in the southeast of England, which is in the top, or southeast of the UK, sure, I should say, which is in the top 10 high value towns or cities, which excludes London. So again, that's interesting to see. Room rentals, what we like to look at, rather than looking at year on year, if we look at what the averages have been over the last kind of 5 years. So we can see the average room rent in the UK in 2019, or Q3 2019, was £600. 5 years later in the same quarter, it's 745. So that's a 4.5% annualised increase. Interestingly, that's less than total rents, and it's far less than new rents. So HMOs, whilst if you look back at this a couple of years ago, outperformed, they're starting to, typical like the average UK tenure, whether it's, so not room rates, is actually outperforming the HMO rooms. If we look at London, that's about on track. So that's about on track with the rest of the market, 5% year on year on average over the last 5 years. Having a look at some of those LHA rates, I've put in Bath and Bristol here because when we did this, we were doing it live in the southwest, so it became a bit relevant. But it's always interesting to look at what the LHA rates are. Now, in the budget, and we'll get to the budget in a bit, these have been frozen, which is not a good thing in my view for housing, but they've been frozen, and what we're going to see is what I think investors should be looking at is what is the spread between LHA rates and your private rents. And I think what we've seen in April 2024, that spread was very small. When we get into the next sort of 6 months, I expect these spreads to be much, much bigger. And typically you'll find that the biggest spread is on room rates, okay, so shared room rates. Right, so looking at affordability for first-time buyers. The reason we look at this is because first-time buyers kickstart that market. They get the transactions moving. So really, really important part of the market. And what you can see here, and this is some great data from Nationwide that they put out, and it's absolutely fantastic, one of my favourite metrics to look at. Because really it's a leading indicator for me for prices, either prices coming down or wages needing to go up to keep prices where they are. And what you can see here is around 1989 that peaked. So the average amount a first-time buyer was spending of their take-home pay got up to about 50%. Okay, what happened just after 1989? Well, there was a house price crash. Look again, 2007, 2008, similar thing. Okay, went up. What happened right after that? House price crash. Look at where we are now. I've plotted this lovely artistic line that plots around where we are at the moment. So it's concerning. It is concerning. We'll go on to what needs to happen. If we break that down into regions, this grey line shows the long-term average of the percentage of first-time buyer income that's spent servicing their mortgage. Okay, the red line is where we are now. So you can see London really is quite unaffordable in terms of servicing a mortgage compared to the long-term average. Yeah, does that mean we're going to crash? Well, at the moment, UK average figure for the percentage of a first-time buyer spent on mortgage, of a first-time buyer's income spent on mortgage is 36.4%, whereas London is 60%. Okay, that sounds quite scary. However, if I tell you all of those are down from the beginning of the year, okay, Q1 2024, the UK average was 39% and the London average was 66%. So actually, over the last, 2 years to be precise, affordability for first-time buyers is better. It's better now than it was over the last 2 years. Okay, but what happened when it crashed? When we saw those house price crashes in 89 and 2007, 2008. So when we had those corrections or crashes where prices reduced by 19% in the late 80s and 15% in the GFC, the scores of these metrics were in 2007. Well, the UK average went up to 45%, so we're a little bit way off there. In 1989, it was 48%. So we can see that 36% is a little bit off where we are there. So I'm not too concerned about a crash. In London, 61% in 2007. Now we are around that figure now. And London in 98, a whopping 79%, absolutely massive. 79% of their first-time buyers' income was spent servicing that mortgage. Absolutely crazy, isn't it? So actually, that's a bit more concerning for London. So the other part of affordability is not just how much we spend, or a first-time buyer, or any person for that matter, servicing a mortgage, how much of the income spent on the mortgage, but it's also about deposits for buyers, isn't it? Yeah. So for a 20% deposit for a first-time buyer, that equates to around 105% of their average annual gross income. Okay, it sounds a lot. It's down from 2022, where it was 116%, but it's still a little bit higher than the long-term average again. Like we said, average is not always the most helpful thing to look at. So we're looking here at house price growth or not, as we can see, like we said in 1989. Now, the astute people here will be saying, hold on, Rod, you said in 1989 it dropped by 19%. Well, this shows the year-on-year drop, so we can see it's negative for a couple of years. So in total, that caused a decline. It took a while to get back. Whereas if you look at 2008, it actually went down and jumped back up. Now, there were different causes, weren't they, for what was causing the crash. 89, it was really servicing costs, interest, debt costs. 2008, it was availability of credit. Yeah, so actually getting their hands on that credit, banks calling it in. So very different issues that cause those things. What are we closest to now? Well, we're probably closer to this level. Okay, at the moment, in terms of these cause, in terms of interest rates really moving up and being able to service those mortgages and affordability, rather than a credit issue. What's different now? Well, we've got very different market outlook there. In 1989, the majority of mortgages were variable. There was far less equity in UK property. Loan to values in UK residential property was far higher than it is now. So again, actually, it's not looking that bad when we look at those. So, gosh, house prices, I'm going to whiz over this. We've got a million different metrics, haven't we? A million different kind of platforms that tell us all these different prices that house prices are, whether it's Nationwide, Halifax, ONS, Zoopla, all these different things. The idea basically is that take it all with a pinch of salt because they're all looking at different data sources. Now, does this mean that we've got distressed sellers? Well, we've got around 25 million households in the UK. In England, it's actually 24.5 million households, okay? There's a bit of argument over the numbers and how those are factored in because we've got a lot of homeless people, we've got a lot of people in emergency accommodation and things like that. So, give or take, that's what we've got. Now, out of those households, 8.8 million own their home outright, so don't have a mortgage. So that's 36% of homes are owned outright. Okay, that's a massive amount. Yeah, so compared to 1989, that's really different. So 36% of people or houses are not affected by interest rates going up. Okay, or not directly affected, I should say. 6.8 million households, or 28% of households, are owned with a mortgage or a loan. 4.8 million are privately rented, okay, and 4.2 million are in social rents, okay, so housing associations, local authorities, right. The value of the residential housing market in the UK is 8.25 trillion with debt of 1.675 trillion. So bloody good, like loan to value there if we look at UK residential real estate. Again, comparing it back to 1989, 2007, far, far more robust at the moment. However, the other difference is we used to have lots of variable mortgages. About 80% of mortgages now are fixed. But we do have around 5 to 7% of mortgage properties are coming up for renewal every 12 months. So it's about 400,000 properties. Sounds like a lot, but actually in the great scheme of things, it's a very small amount. Doesn't mean it's not going to hurt those people when they realise their mortgage interest payments are probably doubling, or if not more. Yeah, so mortgage approvals are up again from a year ago, and we're really back to our 5-year average. So again, don't look at it year on year because then it looks completely out of whack. 45% up, wow, that's massive. But actually, we're about the 5-year average. Okay, so roughly, I don't know, late 60,000s per year. So it's getting to be a decent market again in terms of transactions and people getting new mortgages. What are the types of sellers in the market at the moment? So we can see existing people with a mortgage. How much are they buying? Well, yeah, that's started to go down. If we look over the last sort of 10, 15 years, it used to be about, in 2006, around 50% of the purchases were existing owners with mortgages. That's now around 31%, so a lot less movement there. First-time buyers have come up a bit over the long term, but they've gone down since around kind of 2018, 2020. So the last few years they have gone down. Cash owner or investors have come up a lot in the last 3 years. So since interest rates really spiked, a lot of cash owners or investors, so people who don't need to use mortgages, have really started taking much more market share of new purchases. And buy-to-let investors with mortgages over the last couple of years have really dropped, but around, I'd say, the 5-10 year average, not a huge change there. So what needs to happen in terms of those affordability metrics? Should we be panicking, or should we be thinking actually there's loads of good news on the horizon? So really we need a few different things to play out. So house prices either need to fall further to make affordability more in line, back to kind of where we need things, or mortgage costs need to fall further in servicing costs. Okay, now we did see beginning of the year mortgage costs start to come down. The last few weeks they've come up again, unfortunately, due to things like the budget and what's going on in America have concerned the markets about future inflation not coming down as quickly and sticking around a bit more. Or the other big thing is incomes. We need household incomes to increase, because all of these metrics really come down to how much of someone's income can they spend on their housing. Okay, so if household incomes increase, which we are seeing, incomes are outpacing house prices, they are outpacing inflation, so that's good news, and that can keep things up. So those are the things that need to happen to reset affordability and keep house prices either where they are or moving upwards. So number of homes for sale is at a 5-year high. So sellers need to price their stuff competitively if they want to be in with the chance of actually selling it. So that can have downward pressure on pricing, okay, because there's more supply side entering the market for sale. And then we've got mortgage rates, obviously a massive factor, but remember it's only a factor for those of us with mortgages, okay, and we've seen that 30% don't have that, okay, and then out of the 30%, how much loan to value is there? Okay, so recent budget, American politics hasn't helped mortgage rates. Yes, swap rates have increased on that news because they're concerned about inflation sticking around. Another factor is wealth transfer from baby boomers. We've typically thought, wow, there's so much wealth sitting with these baby boomers and they're all going to die and it's all going to come to the next generation, so they're going to get loads of money to spend on buying new houses. Now, again in the budget, we've seen differences with IHT, so it might not be as much wealth being transferred down, so that could be an issue. Now that will have a disproportionate effect on areas where there's higher value, so places like London and the South East, where people have a much more disproportionate amount of value in their homes and in their property, so it's something to consider. With inflation seemingly under control, but with these tailwinds that we've mentioned, should you hold cash or not? So, maybe cash might be a good thing, or cash just inflates away, don't hold it. Well, if you're leveraged at 75% loan to value and prices drop by 5%, that's a 20% drop in your equity, yeah? But it can go both ways, yeah? I love that saying, leverage is like drugs and alcohol, it just amplifies things, doesn't it? So there are currently real returns to be made on gilts and savings accounts. Inflation is quite, well, is at the moment around, I think around 2.7%, but that could be moving up. But we're getting savings rates that, although they've come down in the last few weeks, are actually still outpacing that, and certainly gilts are too. So opportunities there. It's amazing how many people forget how maths works when looking at risk and volatility. So when you say, hey, I've lost something, or something has lost value of 30%, people assume that they just need to increase it by 30% to break even. They don't. If you lose value by 30%, you've got to increase by 42.86% to get it just back to where it was. Now, when you talk about volatile assets like Bitcoin that are pretty volatile, when they say, oh, I've lost a 50% of its value overnight, well, you need it to make up 100% of its value just to break even. So important points there. Talked about household incomes, okay, really, really important when looking at affordability, okay. So earnings are up 12% in the last year and 28% or 5% year on year from pre-pandemic, yeah, in the last 5 years. So 5% average year on year, but 12% in the last year. So actually earnings always lag all these other things because you typically go to your boss and say, come on boss, I need a bit more money because I can't afford to pay the mortgage costs. And that's what keeps people in jobs. Now, there is a limit to how long that can go on for, but at the moment, that's a positive thing when we're looking at affordability. 12% is massive as well. This is from the ONS as well. If you actually look at the data coming out of some of those credit referencing agencies, they can be a bit better. Average earnings 5% year on year for the last 5 years. That's consistent with kind of average rental growth, but it's higher than new rental growth like we saw. It's also higher than house price growth. So really good thing. It's, well, affordability in real terms is better than it was. So for all those people that constantly say, God, it's so affordable, well, it's more affordable than it was a couple of years ago. So what affects this market? We've got availability of credit. We've discussed affordability, but what affects that? Talked about 2008, banks drying up. We've got a lot of credit in the market, a lot of money looking for a home at the moment. So there's some decent things going on with that. We've got other government intervention. Do not underestimate this. We've seen how impactful policies can be, from kind of George Osborne through to Trussonomics, Michael Gove's meddling with planning, Reeves's budget. Government intervention is really, really important. And then lastly, we've got supply and demand. So everyone talks about supply and demand as if it's the kind of one and only thing that determines that, oh, prices will stay good forever. It is a factor, but it comes after availability of credit and government intervention in my view. So things that affect affordability, earnings per household, yeah, we've talked about that. They need to catch up or prices need to come down. Size of household and the amount of earners that are in it. Mortgage terms, okay, how long is the loan stretched over? Typically a first-time buyer 20 years ago would have a 20-year term. Now it's 40 years, yeah, so you're stretching those payments, so that makes it more affordable. Amount of equity available, or what proportion of the price are people able to borrow? Okay, again, a really big difference. And then obviously interest rates for that debt. So these have rocketed up recently. Obviously important to remember how the mortgage market functions. It's not just on base rate, looking at gilt swaps, also looking at deposit-led banks and how that all works. So inflation, what's going on with it? So many different measures of inflation. We've got CPI, CPIH, we've got owners occupier, housing costs, all these things. And what we can see here is that, look, inflation on the whole has come down drastically since kind of 2022, which is obviously a really, really good thing. We have seen in the last kind of few months it start to creep back up again on news of the budget and what's happening in America. But what is concerning is these owner-occupier housing costs, which have gone up steadily and quite drastically since around 2020. Now this is a funny old metric because the ONS calculates it in 3 different ways. None of them are particularly robust, but really the consistency and the movement and trend is a concern. And look, you're seeing this. If you have to rent the equivalent house, it's going to cost you far more than it was because rents have gone up, supply is down, and this is really where supply and demand does factor in. But affordability is still going to be based on how much money someone can spend. If there's only one house and 20 families want to rent it, you can't just charge what you like, because if someone can't afford to pay it, they can't afford to pay it. Yeah, so that's where wages and household earnings are really important. So CPI up to 2.3%, CPI with housing is 3.2%. The owner-occupier housing component is the highest it's been since 1992. Like we said, it is a bit concerning at the moment. Reeves's budget was inflationary, and it's cost push inflation rather than demand pull, which is a bit more annoying because it tends to stick around longer. And then wages going up, although it's good for keeping rents and prices up, it's not that great for inflation. So we're in this kind of spinning circle here, and it's a little bit difficult to understand, well, at what point will this break? So if we look at the last decade up to December 2023, we saw average residential property increase by 60% in that 10 years, in the decade up to December 2023. So when people say, oh, property doubles every year, no, it doesn't. Yeah, it depends. Detached houses went the furthest. They were 72% up, so that's about 5.75% annualised year on year. Flats were much lower. They're about 4.5% annualised. And inflation in that time was 50%. So house pricing pumped through inflation. It was really good. Wages increased about 43%. So they were below inflation and far below house prices, although now we're seeing a bit of a change there, aren't we? But let's have a look at a decade when there was really high inflation. So if we go back to the 70s, 1970, what we can see here is that inflation rate change. Gosh, look at this, sort of 25% inflation some years, always higher than 5-6%, like mostly over kind of 10%. Really, really high inflation all through that decade. So what do we think happened to house prices then? Well, house prices didn't increase sort of 60% like they did in the last 10 years. In that decade, they went up 413%. That's an annualised year-on-year increase, 18% on average, which is absolutely insane. Inflation in that time was ridiculous at 260% or 13% annualised, but the difference is absolutely monumental. So again, something to think about in an inflationary environment. Supply and demand, let's run through that quickly. Look, we know we've got potential recessional higher rates that we're paying. Okay, we've got residential property developer tax, building safety levy, biodiversity gain, end of help to buy, so many planning issues and increased costs. I mean, the amount of professionals you need to submit a planning application these days, the cost of it is absolutely astronomical, and just cost rises everywhere, building costs, all sorts of cost rise. They provide this perfect storm that's meant there's only 148 new housing starts last year, and that looks to be far, far lower this year. That is a concern. So the supply side is a concern. Brick deliveries, really good proxy for new housing starts, 29.7% lower than last year. Again, that's a concern, not enough building going on. If we look at who was supplying or building houses over time, we can see, look, back sort of in the first sort of 1949 to about 1980, we saw local authorities built a huge amount of houses, huge amount of houses, over sort of 200,000 in the 50s, okay, after the war. Even in the 1970s, the total amount of houses was over 400,000 a year. Yeah, so that's a massive amount. We're nowhere near that. And what you're seeing that's interesting is private house builders now make up the majority of where housing comes from. Local authorities are non-existent in the house building space, and housing associations are also very, very low. And so not only is it the total amount has gone down that's being built, but also it's who's building them has changed. So really there needs to be a bit more emphasis on that private market, because that's who we rely on at the moment for our house building. Wouldn't it be great if local authorities could get back to it? This is a graph that I've actually put together which shows the different tenure of housing over the last 25 years. So we've got the total amount of housing, so it's not 20,000, you can add 3 zeros on, it's 20 million that mark is. So total amount of dwellings at the moment is about 25,000, okay. Rented or private rented, okay, so that's all private rented, whether it's built to rent or what have you. You can see there was some kind of consistent growth until we got to around 2014. What happened then? Well, George Osborne. Since then, it actually declined. So the amount of rental properties reduced, and it didn't get back to that point until about 2021. Local authority rental accommodation has steadily declined. So really, really concerning stats here, really concerning, especially from the private rental sector. And I guess all of you investors will see this day to day. Supply is dwindling. If we look at construction costs, how are they doing? Well, actually, they've come down. Material prices have come down since around 2022, which is a good thing. They're still a hell of a lot higher than they were sort of 5 or 10 years ago. Certainly outpaced inflation on those, but they are coming down. Labour, on the other hand, is not quite the case. So we talked about new housing starts. Our new housing starts in the last year have been around 45% lower than the long-term average. That is a disaster. Okay, 45% lower than the long-term average is awful. So UK construction firms are going under. They're going bust at the highest rate on record. 46% higher than the pre-pandemic average. Again, really, really concerning. Largest impact there is on the smaller specialist subcontractors. We do have new work orders. They're reducing, although things like repair and maintenance has started to increase. So rather than people building new houses, more of that cost and new work is going into just maintaining existing ones, and that really adds up with what we're seeing from housing associations who don't want to buy any more stock because they're too busy fixing up all the previous stock that they've got. So onto that labour market, who's actually building all these houses that we need? We've got over 500,000 UK-born construction workers leaving the sector in the medium term, and that's because they're just getting too old. They're retiring, they're reaching retirement age, and we don't have enough people from grassroots coming into the scheme. Everyone wants to be a yoga teacher, don't they? No one wants to come and be a bricky carpenter or plumber, which is silly because the amount of money you bloody earn at the moment is colossal. So maybe something for you younger people to consider. In Q4 of 2022, 250,000 fewer workers in the UK construction compared with Q1 of 2019. We have seen a lot of the labour from Brexit as well. Really, people are leaving the sector and no one's coming in. That's the biggest concern we have. So labour is a concern there. Immigration. So net migration, the year end to December has been rounded up. Okay, if we see this dotted line was where we thought it was in May. It's recently been released this week actually. So the total net migration in the year ending December 2023 was 866. So 866,000, a lot. Look how much that has spiked in the last sort of 4 or 5 years. An awful lot. So yeah, Brexit didn't really have the desired effect if it was to slow down net migration, clearly. There's an estimated 28.4 million households in the UK in 2023. That's an increase of 7.6 over the last 10 years. So 8.4 million people live alone in 2023. So households making up just one person was about 30% of all households. 2.36 is the average amount of residents in a household, and we've got 200,000 new households were formed last year, and that's rising every year by about 0.6%. Yeah, so that's not actually including that 866,000 individuals of net migration. Now remember, that's individuals, so if we work on a 2.36 average, that's probably another awful lot of households that we've got to find. We are certainly not having a net increase of that amount of housing, which is really worrying. So when you've got government talking about 1.5 million by the end of their 5-year term, well, by that point, I mean, now it's even more of a concern now, but by that point, it's going to be massive amount of demand needed. Onto some of the public markets. So if we look at some of the UK residential REITs, what we've seen is share prices have started to increase over the last 7 days. Some things are happening. We've got, interestingly, PRS REIT, which specialises in kind of build to rent, so new build, has had an absolutely fantastic year. Granger, which specialises a bit more into kind of total residential, so not just new build, but a lot of existing build. Really mixed year in terms of share price. So investors are concerned really about that. What it is doing, well, what all of them are doing, is showing earnings have really moved up. But the price to earnings ratio, 13.2, is way below the kind of 18.6 10-year average. So always interesting to see what the public markets are doing, because they, again, are precursor for most things. So what can the government do to sort this out? Well, it's a bit out of our control, really, isn't it? But they can use the carrot instead of the stick to encourage investment. Doesn't seem to be what they're really doing at the moment, which is a bit concerning. You've got kind of Homes England there, not spending any money on anything. They can ease planning, or if they tighten it, we've got to adapt to that, haven't we? They can ease tax or tighten, ease legislation or tighten, ease bank legislation or tighten. Now, if they do tighten, what that gives is massive opportunity for those existing in the market to pick up market share. So don't just think of it as a terrible thing. Actually, it can be quite a positive thing if you're already in the market. What should we be concerned about as investors? Well, look, what other staples of living can increase disproportionately for our target market? So, for example, when you've got the lowest kind of decile of household earners, their energy costs went from around 7% of their total income being spent on energy to almost 20% when energy costs last went up. That really is a disproportionate increase in a staple of living, and it's not like those households don't have discretionary budgets. So where does it come from? Does that come from then they've got to take a little bit out of their food budget, a little bit out of their clothing budget, some out of their transport budget, and some out of their housing budget? Okay, so what that means is maybe rents can't go up for them, or arrears start to come up, issues start to come up, maintenance might start to come up because now they're not going to pay the heating bill. Okay, heating doesn't get turned on because actually they're prioritising rent. That can cause damp mould issues, and then we've got maintenance issues. Okay, so these can be concerns. Forward selling. So forward selling is great if you want to get kind of secured sales, but if it's a fixed cost, if it's fixed or your revenue is fixed essentially, but your cost over that time increase, then you can reduce margin. It can be a bit dangerous. Fixed price rents that don't go up with the market. Lots of people are fixing rents on kind of guaranteed schemes, and I do say schemes with inverted kind of commas. Just be careful because the market rents are ramping up, and it's a lot that you're going to miss out on. Funny when people kind of look at what their yields are. I don't know why they don't. What you really should be doing is looking at the yield over a time. So it's a blended yield. Say if you're looking at an investment for 5-year term, look at the blended yield over the 5 year. Don't just look at the first year. It's crazy. Variable loans, again, look, interest rates going from 3.5% to 6% is an increase in your monthly interest cost of 85.7%. That's massive, isn't it? So look at how high your debt to income ratio is now. Yeah, that's a good thing to be looking at. Illiquidity, don't get caught up making all your cash work. Yeah, so be careful, have some liquidity as well. And look at how much your debt is exposed at a specific point in time. What do we track here? Well, we look at various things. We look at debt servicing as a percentage of our rent. We look at lettings costs as a percentage of rent, maintenance as a percentage of rent, other costs, so that aren't included in those ones. That will be things like insurance, accountancy fees, all that kind of stuff, running a business cost. So those as a percentage of rent, and then look at the percentage of a tenant's household income that they can spend on rent and of your target market. Okay, that's going to let you know about certain opportunities and risks. And then we can look at kind of net income as a percentage of rent, loan to value of your total debt. Yeah, look at secured debt and unsecured debt. Look at your cash flow. If you've got bounce back loans, it's really cheap debt, but actually on your cash flow, it takes a chunk out because it all goes back onto your balance sheet. Yeah, so you might be thinking, hey, our P&L is showing really good returns, but we got no money in the bank. That could be a reason why. Look at your releasable equity. So what you actually get after you sell. So tax implications, sales costs, that sort of thing. Total returns over a period of time. Don't just look at your cash flow, look at your equity going up. Look at IRR, yeah, really important for people. As we said at the beginning, myself and Adam Lawrence have a 1-day property business workshop on the 16th of January. If you've come to our workshops in the past, we do one every quarter in person, always in London. They are great, of course I'm going to say that. We talk about really the boring, unsexy stuff in property that no one else wants to do because it's boring and unsexy. But it's really integral to making your business scale and getting an efficient business. So January we'll be going over financial accounting and bookkeeping processes for business owners, so property business owners, what you need to be looking at, what you need to be focusing on, how you can set up some of those systems. Please have a look, click on the link, have a look at the tickets. They do sell out. We get about it's around 50 people is the capacity, so they do sell out quite quickly. So please go on, have a look at those. Great events. We get great people in the room. It's not for people that are new to kind of property. It's not going to help you. It's for existing business owners really, and existing portfolio holders. So have a look at that. Hope you enjoyed it. Please give me some feedback. If it's good, leave us a review. If it's bad or needs a bit of improvement, let me know. Let me know. We want to make things better for the listeners, for the viewers. If you enjoyed it, if you want it to become a bit more of a regular thing, maybe once a quarter, once every 6 months, please let me know. Thank you very much.